Can you see that?
Looks great.
Okay, you're cutting out on me a little bit, so I'm just going to keep talking. If I start
Okay.
cutting out, let me know. Fair enough?
Fair enough.
Okay, so I don't know how to get rid of this. There we go. So this is like basic real estate principles. I'm just going to share the 4 reasons why everyone should invest in real estate. And I'm going to cover the very basics as if you don't know anything. So if you're offended by how simple I tell you, I apologize. Okay. So I'm going to tell you what I'm going to tell you, then I'm going to tell you, and then I'm going to tell you what I told you. So a person should invest in real estate for 4 reasons. And if you can't hear me, Michael, just start hollering at me and I'll stop. The first one is for appreciation reasons. Second one is cash flow. Third is leverage. Fourth is tax advantages. And there's 3 types of tax advantages. And they're not listed in any order of importance, but that's what I'm going to tell you today. The first reason is for appreciation. Appreciation isn't the type that, I really appreciate the Martin family. They're all great people, but that's not the kind of appreciation I'm talking about. I'm talking about the appreciation that happens in a market where real estate prices are rising. And so if you buy a house today for 100,000, over time, just if you continue to breathe air, 5 years from now, the house will be worth more. And the theory is, or my statement is, that over any 10-year period in time, real estate has always increased in value. And if you go to these websites here, you can read all about all of that, but I've copied one of them here for you. And you can look right here. This is 1953 through 2019, and you look at real estate prices and what they're doing. And if you just take any 10-year period of time on this, the slope is positive on the line, which means it's going up in value. You can see the dip that happened here in 2008, but even if you bought in 2007 or 5, 10 years later, the blue line is already above the other line. So appreciation is a simple concept. I only have these 2 screens to show you about it. Michael, can I proceed on?
Yeah, go for it.
You hear me? Okay, you can hear me.
Yeah.
Okay. The second reason is cash flow. Cash flow just means that if you have a mortgage payment of 1,000 and you're getting rent of 1,400, you might make $400 a month if you don't have any major repairs. And the principle is the more you leverage, which we'll talk in a minute, the more real estate you control. Your cash flow may or may not be larger with 10 properties over 1 property. It just all depends. All of our cash flow profits can be sheltered by the real estate itself through depreciation. I don't invest in real estate for the cash flow. That's not the main reason, but if you can make a positive cash flow, and you can, that's just fantastic. But you don't invest in real estate and plan to just live off of it at your age. If you buy a property at your age, by the time you're my age, you can live off of it because there is a positive cash flow. And I'll talk about more of that in a minute. Third principle, leverage. So leverage is a principle. If you have a teeter-totter, and you've ever been on a teeter-totter before, you know that you can put a big fat person down here on this end, or a light person here or whatever, and if you put some pressure over here, you can lift a lot of weight by a person over here pushing pressure because the fulcrum has been moved closer to the load you're trying to lift. And this is just a symbolism of leverage, but an example of leverage that I want to share with you is some basic principles that I'm going to go through with you, and just here they are. You can borrow on real estate using other people's money. Sometimes I call it opium, like the drug, other people's money, OPM. You can borrow on OPM, other people's money. And the reason is because real estate is considered stable. It can't move, And in the investment pyramid, if you have the pyramid, the top of the pyramid is risky stuff that you invest in. Real estate is at the bottom of the pyramid. You can put 3% down and borrow money at 2.75%. Why would anyone in their right mind, as a bank who's super conservative, why would they loan you money on real estate with only 3% down and it's such a low interest rate? The reason is because they view it as being a stable investment. It's at the bottom of the investment pyramid. If the house burns down, you got an insurance policy that'll pay the loan off, and it can't move. It doesn't move around like a car. It's not a stock that, if Elon Musk makes some kind of mistake and the stock drops, that doesn't happen to real estate. So the concept of leverage, I like to demonstrate in this way. How much cash, hold on, this is my wife. Hey, Monica. No, I'm doing that real estate presentation with Michael Martin right now with 30 people, so I'll call you on that. Okay. Okay, bye. Sorry about that. So how much money do you need to buy $100,000 worth of stocks? Some of you may be educated in the stock market and you'll challenge the statement, but for simple reasons, Simple Simon here, you need $100,000 to buy $100,000 worth of stock, unless you do other techniques. But for now, just let me make it simple here. How much cash do you need to buy $100,000 worth of real estate? Well, you can borrow money from a bank to buy real estate. So in this example, I'm saying, let's suppose you put 33% down and you get 66% debt. You can pretty much buy anything if you're willing to put 33% down, and you can borrow the other 2/3 of it on real estate at favorable rates and borrow on it. Anyone will loan you a first position on a piece of property like that. How much cash do you need to buy $100,000 worth of real estate? Well, you can get a 90% loan. You can only put 10% down if you want and get 90% debt. So unless you use some sophisticated measures to buy stock with debt or puts or calls or margin your stock or whatever, you pretty much need cash to buy stock. And so in real estate, you can leverage. What happens to your net worth under both scenarios when the market goes up 10%? So for example, if you buy $100,000 worth of stock and the stock market goes up 10%, how much wealth have you created? The answer is 10,000. In real estate, if you bought $300,000 worth of real estate because you put 33,000 down on 3 homes, borrowed the rest, you now control $300,000 worth of real estate with loans of 66,000 on each one, and you put $33,000 on each one for the total of the 100,000 cash you had, and the market goes up 10%, you now have made 30,000. So you can make 3 times as much if you can buy 3 times as much and control 3 homes versus 1 home versus just 100,000 in stock. So another example is if you had $1 million worth of real estate because you put 10% down on 10 homes, then you could, market goes up 10%, you own $1 million worth of real estate, you made 100,000. So your wealth increases exponentially in real estate because of your ability to borrow money for a small interest rate amount and to leverage, because anyone on the planet, any bank will loan money to someone to buy a house. I'm going to keep going. I'm going to really accelerate the example to just drive the point home. Stock market increases by 10%, you make 10,000. We covered that one. You buy 3 houses, $100,000 each. You put $33,000 down. That's your 100 grand. You get 66,000 debt on 3 homes. You owe 200,000 of debt. The market goes up by 10%. You made 100. You make whatever you make there. What is that? 100,000. Whatever. That's 30,000. I think I'd use in that example. look at the next one. If you can buy 10 homes with 10% down, and again, I'm exaggerating the example for you here, and it's possible to do that if you use different kind of financing techniques. You could control $1 million worth of real estate with $100,000 if you were allowed to put 10% down. And in that example, you own 10 homes at $1 million, the market goes up 10%, and you make $100,000. I don't think the first three principles that I have described are very difficult. I'm going to review them real quickly. Properties go up in value over time. That's one main reason to buy them. They have a positive cash flow, although sometimes they don't, but that's an advantage. Eventually, if you have a fixed rate loan for 30 years and your payment is $800 and your rent's $1,000, over 30 years, the rent's going to go up to $2,000, $3,000, and your mortgage is still at $800. So eventually, as the market goes up with inflation and rents are more, if you've locked in an inflationary period with a fixed rate loan, the margins of cash flow just get larger and larger the longer you own the property. Leverage, we've talked about leverage on how you can borrow money very easily. All you need is basically, a pulse. If you have a pulse, you can get a loan if you have good credit and a job. So it's not hard to borrow money to buy real estate. And in a first-time home buyer, I love it when people tell me why I would never get it. I can't qualify. It's just not true. It's not true. You just need a little bit of money down and a good credit report and a good job, and you can get a house. In America, they want everyone to own a house. They like communities where people are homeowners. They have a lawn, they mow the lawn, they plant the flowers in the garden and have a picket fence. And we love it when people have their own home. We think it makes a stronger community. So the government and everybody in society wants you to buy a home. I'm now going to talk about the tax advantages. One of my backgrounds is I did a JD Mac at BYU and became a CPA and a lawyer, but the CPA part of it is now the tax advantages to real estate. And these are the real reasons why you really should buy real estate. This is the real reason. These are the amazing advantages. If you understand these, then basically Uncle Sam will buy the properties for you because you won't be paying as much income tax. And with that tax savings, you can buy property. Are you still there, Michael?
Loud and clear.
Okay, you can hear me.
Yeah.
Okay, I'm gonna keep going. Get rid of that. I know how to get rid of that now. There we go. So there are three main tax advantages, and it's the real reason why you buy real estate. The first tax advantage, most people have heard about it. There's a section in the Internal Revenue Code that's section 1031. So they call it 1031. Therefore, they call them 1031 exchanges, but really they're like-kind exchanges. And there's all kinds of like-kind exchanges. If you sell a truck and buy a truck, that's a like-kind exchange. You buy a house, sell a house, buy another house. So in real estate, if you sell a property and buy another one for the same amount of debt and the same amount of cash, you don't pay a tax on that. Okay, it's just a loophole in the tax code that says, if someone sells a piece of property, we want to motivate them to buy another one to make our community stronger and have people be owners, that we're going to let them do a 1031 exchange. 1031 exchanges are not allowed on personal residences where you live. They have a different law for that right now. If you sell a personal home, you can make the first $500,000 tax-free with no questions asked. You don't need to reinvest or anything. But we're talking investment properties here. And so if you sell one and buy another one for at least as much cash and debt, you don't pay any tax. How much taxable gain do you have when you sell your stocks? Well, if I want to sell an IBM stock and buy an Apple stock, there's a capital gain associated with that. And the capital gain rate is 20% if it's a long-term capital gain, meaning you've held the stock for more than a year. If it's a short-term gain, the tax rate can be even higher. And these are federal rates. You also have state tax of 7% or whatever it is. And so when you go in and out of stock, there is no like kind of exchange in stock. There's no code section that allows you to buy and sell stock and not pay tax. Every time you do a sale transaction to buy another stock, you got to pay tax as a step that you go through. How much taxable gain do you have to how much taxable gain do you have when you sell real estate? It can be zero if you reinvest the money. What happens to your net worth under both scenarios? And I'm giving you an extreme example to make a point here that if you buy and sell stock 7 different times and the market goes up a certain amount, you'll make 68,000. Whereas if you do real estate, you can make 948,000. I'm going to show that to you in an illustration on my next slide. And I'm going to do that right now. So let's suppose that you have 100,000 in cash. And on in transaction number 1, so it says turn number 1, you invest 100,000 in stock, the market goes up 10%, you have a 10% gain. You've got to pay at least 20% federal capital gain tax on that. I'm not going to count in state tax because some states don't have any tax and other has, I don't know what the rates are. So when you go to buy the excuse me, the Apple stock, you really only have 108,000 that you can spend on that because you have to pay the tax. Turn off this air conditioner that's blowing on me. So you take that 108, round 2, you buy another stock for 108, it goes up 10%, you make 8,000, you pay 1,600, you're left with 114.4. You invest that 114.4 for the 3rd time, it goes up 10%, you make 11,440, you pay 22.88 in tax, now you have 123,000. You invest that again, number 4, number 5, number 6, and by the 7th time around, if the market's gone up 10% 7 times and you sold each time, your increased total, you started with 100,000, and after tax, you end up with 68,000. Okay, I hope you understood that. With property, if you take that same 100,000 and you buy $1 million worth of property with 10% down, because all you have is that $100,000, okay, and you're leveraging in, so you get a loan for 900,000 and you put $100,000 down if it's an apartment complex or whatever you're doing with it, and the market goes up 10%, you're going to make 100,000 because you've leveraged into the property with low interest rates, and the tax is nothing. You now take that $1.1 million and you buy house number 2. You roll the money in a 1031 exchange into the second property, and you now have $1.1 million that you bought a property for $1.1 million. The market goes up 10%. You made 110. Now you have $1.210 million. You put the $1.210 million in round 3, make 10%. You made 121,000 that time. So now you have $1.331 million. You invest that. Now you have $1.464 million, 100. Round 5, that 10% goes up. You make 146,000. Pay no tax. Now you have $1.6 million. You invest the $1.6 million in the 6th property. Goes up 10%. You make 161, etc., etc. At the end of the day, you can increase your wealth by 948,717. So I'm going back to this slide saying that the difference, because of the tax laws with regard to real estate versus stock, and I'm using stock as another investment vehicle, it could be something else, you can make 68,000 of wealth increase, or you can make 948,000 given a real estate investment, which is an incredible tax advantage that you can take advantage of in real estate. The next issue in real estate is depreciation. Depreciation, I'm not talking about depreciation where you buy a car, you drive it off the lot, and you've immediately lost $20,000. Or you buy a boat, and 5 years later, it's worth much less. Depreciation is it's a tax term, and because of depreciation, you can shelter the income from the property. If you have positive cash flow, you can shelter it and make that money tax-free. And I'll explain how that works in the tax code in this fashion. And I'm going to do it as basically as I feel like I can here. So if you make $10 in a business and you buy a pencil for $1, your profit is $9. Revenues minus expense is profit of 9. Is that correct? The answer is yes, that's correct. If your sales are $6,000 and you buy a truck for $5,000, is your profit 1,000? Putting section 179 aside, for those of you who are aware of that, your profit is not 1,000. The reason it's not is because the IRS does not allow you to deduct the $5,000 truck price in the year you buy the truck, because the truck has what they call a useful life of 5 years. So they want you to write the truck off using a depreciation method, a straight line method. You take $5,000 divided by 5 years, which is the useful life, and they're going to let you take a deduction of 1,000 per year. So you look at that and you say, okay, I had 6,000 in sales. I bought a truck for 5,000, but now I got a profit of 4. I got to pay tax on 4,000, but I just spent 5 grand on the truck. And so the Internal Revenue Service has made a section 179 code exception for small businesses. Small businesses can go ahead and write it off in that year. It's an exception. But if you're a big company like, Federal Express, and you're buying a truck for 5,000 and you make a lot of profit, you don't get to take advantage of section 179 because that runs out at a certain amount of profit. So what happens is companies may not have the cash to buy the truck, so they have to get a loan to buy the truck because they don't get an expense in the year they buy it. So they're forced to go into debt to buy the truck because the IRS doesn't give them a deduction all in year one, because the truck lasts for longer than a year, has a useful life that's longer. So down below, I wrote useful life is 5 years. You take 5,000 divided by 5 years equals 1,000 a year for 5 years as a write-off. So every year you get a write-off of 5,000 for having bought that truck. It's just a code section. That's just how it works. And you just kind of memorize that. So let's accelerate that example and say, let's suppose your sales are 100,000 and you buy real estate for 500,000. Is your loss 400,000? No, it's not. Again, they don't let you take a deduction of the house you paid 500,000 for, because it has a useful life according to the revenue code of 27.5 years if it's a residential property. If it's an office building or a commercial building, retail, it's 39.5 years. So you have to write that property off over 27.5 years, even if you paid cash today for it. So in a way, it's not really fair because you're out the money and you don't get the deduction for it. But that's the concept of depreciation. Your profit is really, you take the 100,000 of sales, you buy the real estate for 500,000, and you have to take that useful life of 27.5 years. You take the 500,000 divided by 27.5 years. You only get a deduction of 18,018 a year. That's the deduction you get. I wrote the word profit there, and that's not correct. You take your sales minus the 18, and your profit would be the inverse of that number. It's really what, 81,002 whatever. But that's an illustration of how the IRS code works on depreciation. You don't get the deduction in the year that you buy a property. But here's the difference. If you buy a property for $100,000 and you only put $10,000 down, you have a loan for $90,000 and you've signed on that loan, you're at risk for that loan. Therefore, you do get the $18,000 of depreciation, even though you only spent $10,000 to buy the home. The rest was debt. So for the next 27 years, you can make $18,818 every year on that property and rent. And if this is your business, you can take that loss against any other income for 27 and a half years. So if you buy a $500,000 property, you can make $18,800 every year and not pay a tax on that. It shelters that income from that property. That is the concept of depreciation so far, if I have explained that well enough. So I'm talking about Section 1031 exchanges, which I've just covered, that if you roll through property, unlike stocks, you don't have to pay tax in between. Your wealth grows because you're paying no tax as you trade up in properties and get something better and better. And in my example, I suggested that you sell the property for some price and invest that exact price, when in reality, that's not what we do. When we sell the property for a gain, we don't just buy the same amount. We have more cash now, so we actually can buy more. So it's actually an accelerated example that is real life. Depreciation, when you buy a property for $500,000, you divide it by 27 and a half years, and you get all of that money for 27 and a half years, you get an $18,000 write-off every year. So it shelters any cash flow that you make by the depreciation, which is a paper loss. And then when you sell the property, your basis has been decreased by the amount of depreciation, but it doesn't matter because you roll into the next property and that basis just keeps rolling over. Okay, the last concept I want to tell you about tax advantages is what they call cost segregation studies, and then bonus depreciation, which I want to tell you about. So my last slide is this one. Back to that property that you bought for $500,000. You can either take straight line depreciation, which is $18,000 a year, or you can hire a CPA firm to do a cost segregation study. What that means is they segregate the property you purchased, this $500,000 rental duplex or whatever it is, a fourplex, and you segregate out each component of the house into different silos. There are 3-year assets in a house. For example, you look in the Internal Revenue Code and it will say all the light switches, we think those are going to last 3 years. All of the light fixtures maybe will last 3 years. The doors, they may last 5 years. The curtains may last 3 years. The carpet may last 7 years. The moldings may last 10 years. So you open up the revenue code and you look at the CPAs do this for you. You don't have to do it. And they put all of the components of the house that have a 3-year useful life into a category. And let's suppose that of the $500,000 property, 75,000 of that is 3-year assets. You know, it burns up in a 3-year period. 50,000 of that burns up in 5 years. 52,500 of it burns up in 7 years. And 10-year assets is 120,000. Anyway, you look at the bottom row here and it adds up to 500,000. But if you look at the actual depreciation you get in year one, you get 25,000 from the 3-year assets. You get 10,000 from the 5-year assets, 7,500 from the 7-year assets, 12,000 from the 10-year, 8,000 from the 15-year, 3,000 for the rest of, and you get $65,000 in year 1, 2, and 3. So what I'm saying to you is that if you cost segregate, which is an accelerated depreciation method, as opposed to straight line, instead of taking 18,000 a year, you get to shelter 65,000 a year. So let me just put that in perspective. let's suppose you're 24 years old, you have a job, whether you do summer sales or whatever it is, and you make, $50,000 in a year or whatever, and you put together $100,000 and you go buy, you put that down as a down payment on a $500,000 property. Let's just pretend you're gonna get somewhere around 65,000 in year 1, 2, and 3, which totally shelters not only the income you're going to make from the property, it's going to shelter other income that you make if you are actively involved in real estate. And there's some rules about that, but if you're managing your own property, then you're actively involved in it because you're managing it. So, and if your husband's a doctor and your wife is managing the properties, you file a joint return, you can write off the real estate losses of 65,000 against the doctor's income. Okay. So you look at this and you get 65,000 the first 3 years, 40,000 in years 4 and 5, 30,000 in years 6, 7, and then in years 8 through 10, you get 23. Way down here in year 16, you're only getting 3,000 at that point. But it doesn't matter because you've taken all the depreciation up front. And so what happens with this cost segregation study method is that you have a CPA and they give you a big, thick cost segregation study. It's a big, thick document, and it just says in year 1, 2, and 3, you can take 25,000. In year, for the 3 years, and it lays it out just like this. And you just go, okay, in year 1, I could take 65,000. Year 4, I take 40,000. And that's the amount of depreciation that you get. That depreciation will shelter that amount of revenue. So imagine if you made $65,000 in a year, you don't pay any tax on that. It shelters it all, okay? If you're active in the business. One more thing I want to tell you is that effective September 27th of 2017, Congress signed into law a bonus depreciation, which did not exist before that. If you put a property into service after September 27th of 2017, meaning you buy it and you start renting it, you can take all of the first 7-year assets in the first year. So for example, and it comes out to about 30%. So of the $500,000 house you bought, in the first year, you can take 30% of that roughly in the first year. It's called bonus depreciation. Congress wanted to stimulate people to buy real estate and invest in their communities. So they're giving you 30% of the price you paid in the first year. 30% of 500,000. My calculator is not working properly right now, but it's, I don't know, 130,000, something like that. So if you bought a home, if you bought something for 500,000 right now, in year 1, you could take $130,000 deduction in year 1 in 2021. Let's suppose you say to yourself, well, I didn't make 130,000. You can go back 5 years. So you can take all of that deduction in 2021, go back to 2020, 2019, 2018, 2016, 17, 16, and 15, and you can get a refund of any taxes you paid in the last 5 years. And if you still haven't used up the 130,000, you can roll it forward. It's called an NOL, a net operating loss. You can roll net operating losses forward 15 years. So buying real estate today, if you can scratch up together a down payment and buy it and implement a cost segregation study, you can save taxes going back 5 years and forward 15 until you've burned up all of that 130,000 in year 1. But you also get all of this other, you get the 10-year and the 15-year and the 3-year. You get to take all of this years 3, 5, and 7 up front in year 1, but you still get 12,000 for this property, 8, and this. You still get another bunch of depreciation every year. You keep doing it. So in summary, in my little real estate 101 here, there are 4 reasons you want to buy real estate. 1, it will go up in value. You can bank on that. Everyone does. The banks bank on it, investors bank on it, and it's just a matter of fact over any 10-year period of time. And real estate's a long hold, okay? People flip properties and all that, but in my world, it's at the bottom of the pyramid and you're just going to hold on to it. It's like a life insurance policy. You pay $500,000 for the house, 30-year loan, in 30 years it's paid off, and now it's worth $5 million, you know, and that's like a $5 million life insurance policy that you buy, and there it is. Second reason is cash flow, and that's an obvious one. And the best thing about cash flow is right now, well, at any time in history, pretty much, your fixed rate loan stays the same for 30 years. It doesn't change, but rents go up. So your cash flow increases over time just because of inflation, and your loan is not subject to inflation because you've locked it in at a certain rate, and that's what you're going to pay every month for 360 months. Leverage, that just means you can borrow money very easily on real estate. It's really easy to borrow on it. You just need a pulse. You need to be alive, breathing. You need a credit report that's 620 or better, and you need a job, some kind of job, and then you can buy a house. Tax advantages, you can just keep exchanging and exchanging until you decide to stop. They call it what's the word? Swap till you drop. You know, we say that in the industry. You swap property until you drop and die. You just keep swapping until you're done. Depreciation, explain that to you, how you buy a property for $500,000, you can write it off over 27 and a half years at $18,000 a year, or you can do the cost segregation study and accelerate it with bonus depreciation and get a 30% of it in the first year, and then you're accelerating it all the other years. So the idea here is that truly Uncle Sam subsidizes you to buy real estate. They're willing to give you a deduction of $130,000 in year 1 to motivate you to buy stock by making it so you owe no tax. If you own enough real estate in your life, what you end up doing is you go to your employer and you say, look, just stop taking any state or federal tax from my paycheck, because I'm not going to have a tax liability because I've got this $130,000 loss that I'm rolling forward. And you're just going to get a paycheck with no income tax taken out of it. With that savings of the income tax, you have more discretionary income in your pocket to buy another piece of real estate to just perpetuate this tax benefit appreciating property that spits off cash flow and you bought with somebody else's money. I am currently in South Carolina. Yesterday I was in North Carolina, buying properties here, talking to my contact here, a person who works for me, who lives here, who I help buy property. She bought a property, it's 2 people. They bought a property in February, and already right now they could refinance the property right now at 80% of its value today and pull out all of their down payment. They literally have made $50,000 from appreciation alone, such that they can go refinance that house and pull the down payment back to them that they put into it. And when you borrow money on real estate that is appreciated and pull money out, it's tax-free money, because when you borrow money, it's not income. You don't pay tax on loaned money. If you borrow money from the bank, they don't say, oh, that's income, pay income tax on it. It's not income, it's borrowed money. So when they borrow $50,000 on their house and get back their investment, it's tax-free, and now they have $50,000 to go buy the next one. And literally they have 5 properties now, and all of them have gone up like that. So they can pull $250,000 back out and go do it again and buy 5 more. And it perpetuates upon itself to where you can just keep doing that until you get tired of doing that. Really, you can do it forever. That is my presentation. I try to do it in 1 hour. I think I did it in less than an hour. I'm happy to answer any questions that anyone has about anything I've said on these principles on the screen, if anyone has a question.